Hello, friends. Recently, Sam Altman, the godfather of the AI world, was directly challenged. On a podcast, a prominent investor, Brad Gerstner, asked him a probing question. Buddy, your company's annual revenue is only a little over $10 billion. How dare you make a $1.4 trillion spending commitment? And guess how Altman responded? He stiffly said, "If you want to sell your stock, I'll find you a buyer." Shut up. This reaction basically means either believe in me or get out. So, what exactly is going on here? Why would an investor dare to ask such a question? And why would the fundraising party be so arrogant? Today, let's thoroughly dissect what is, so far, the biggest financial paradox in the AI world, OpenAI. How can a company that burns $46 billion a year be valued at $500 billion and still dare to launch a crazy $1.4 trillion gamble? Is this the emperor's new clothes or a true dragon-slaying technique? First, we need to understand just how exaggerated these numbers are. A $500 billion valuation, what does that even mean? This makes OpenAI surpass Elon Musk's SpaceX, becoming the most valuable private company globally. This valuation is already detached from any traditional financial metrics, such as revenue or profit. A $46 billion annual loss? I'm not making this up. This is deduced from the financial reports of their major backer, Microsoft. Microsoft holds a 27% stake in OpenAI, and in one quarter, due to its investment in OpenAI, it lost $3.1 billion on paper. If you divide $3.1 billion by 0.27 and then multiply by 4 for the 4 quarters in a year, the answer is approximately $46 billion. A $1.4 trillion spending plan? This number is already surreal. It's 50 times higher than the total cost of the Apollo moon landing program in the US, even after adjusting for inflation. A company that loses $46 billion a year is valued at $500 billion and plans to spend another $1.4 trillion. Does this make sense? Let's first look at the bear case, which argues that this is absolutely an epic bubble. The strongest evidence comes from OpenAI's rival, Anthropic. This is like a large-scale A/B test. Group A, OpenAI, believes in the big investment, big miracle strategy, invest first, monopolize later. They do everything: video, search, healthcare, expanding scale regardless of cost. Group B, Anthropic, takes a lean B2B game approach. They focus on enterprise customers, which account for 80% of their revenue, and consciously avoid extremely capital-intensive businesses like video generation. Now, let's look at the predicted health report for 2028. Anthropic is expected to be profitable in 2028. OpenAI is expected to have an operating loss of $74 billion in 2028. This is the core of the bear case. If by 2028, Anthropic is making money while providing AI products that are just as good as OpenAI's, wouldn't that prove that OpenAI's annual losses of tens of billions and that $1.4 trillion gamble are not necessities at all, but an epic misallocation of capital? The bubble might not be AI technology itself, but OpenAI's at all costs crazy strategy. All right, after hearing the bear case, do you feel like OpenAI is about to collapse? Don't rush. Let's listen to the bull case, which suggests you don't understand because you're not standing high enough. Bull investors believe that everyone has got it wrong. First, the $500 billion valuation is not meant to reflect value. It's a tool for fundraising. This is like playing a game. By anchoring its valuation at $500 billion, OpenAI has created a high-value currency, its own equity. It then uses this currency to leverage that $1.4 trillion infrastructure plan. Second, this isn't a SaaS software business. It's an AGI, or artificial general intelligence, gamble. OpenAI's charter states that shareholder returns are limited unless AGI is achieved. Investors are buying into the probability of it achieving AGI, not its current revenue. Some analysts have calculated that if AGI is worth $10 trillion and OpenAI has a 3% chance of achieving it, that justifies its $300 billion valuation. Third, and most crucially, capital as a moat. When AI algorithms become increasingly commoditized, the only remaining moat is capital. This $1.4 trillion gamble is a blitzkrieg, aimed at raising the cost of competition to an unattainable level. This is like building a moat. While others are still digging small ditches, OpenAI directly announces, I'm going to build a Mariana Trench. By the time it's built, other players won't even be able to scrape together the money to build boats. So how can they compete? This is why SoftBank recently did something big. It sold off $5.8 billion worth of NVIDIA stock and immediately provided funding for OpenAI's $40 billion investment. Masayoshi Son's logic is that NVIDIA is a shovel seller with limited upside, while OpenAI is the gold miner. So he sold the shovel to fund what he believes is the king. All right, now comes the most critical question. Even if this is a genius plan, how can a company that loses $46 billion a year come up with $1.4 trillion? Now, welcome to the new way of playing in the AI world. The financial magic of left hand to right hand circular financing. This is a self-feeding ecosystem where the identities of suppliers, customers, and investors overlap. Let me give you 2 examples, and you'll immediately understand. Cycle 1, NVIDIA's supplier financing. This is the simplest. NVIDIA invested $100 billion in OpenAI. OpenAI then used this money to buy GPU chips from NVIDIA. Jensen Huang calls this a smart investment. Of course, the money they invested directly became their own revenue. Cycle 2, Oracle's synthetic capital. This is even more brilliant. Practically empty-handed white wolf. OpenAI approached Oracle and said, I promise to purchase $300 billion worth of cloud computing services from you over the next 5 years. Note that OpenAI didn't pay a single penny up front, but this promise alone caused Oracle's stock price to surge, with its market value skyrocketing by $200 billion in a single day. Oracle now has an additional $200 billion on its books. It can then use this inflated balance sheet to borrow real money from banks and then buy $40 billion worth of real NVIDIA chips to start building this $300 billion infrastructure. Do you see it? Without using any cash, OpenAI leveraged $300 billion worth of infrastructure to begin construction simply by trading on its future needs. This is the new AI economics of 2025. The promise of future computing power itself has become an asset that can be immediately capitalized. Finally, we must talk about the most crucial insider, Microsoft. Isn't Microsoft OpenAI's backer? Its equity investment in OpenAI leads to a $3.1 billion loss on its books every quarter. Has Microsoft become a sucker? Friends, this might be the most cost-effective loss in tech history. Microsoft is playing a perfect two-way hedge game of Go. Scenario 1, if OpenAI truly achieves AGI and becomes a $10 trillion company, then Microsoft with its 27% stake wins big. Scenario 2, if OpenAI runs out of money and goes bankrupt midway, Microsoft still wins. Why? Because the investments OpenAI received previously, including Microsoft's own money, were all used to pay Microsoft Azure Cloud's exorbitant bills. In other words, Microsoft actually used OpenAI's money and promises to subsidize its own global infrastructure construction for Azure AI Cloud. That $3.1 billion paper loss every quarter is not a loss at all. It's Microsoft's research and development expense paid to itself. But OpenAI isn't foolish either. It's now also de-risking. It first went to partner with Oracle for $300 billion and then signed a $22.4 billion agreement with CoreWeave. The goal is to break Microsoft's computing power monopoly. The symbiotic relationship between the two has ended, and the co-opetition has become public. All right, let's summarize. OpenAI's $500 billion valuation, $46 billion annual loss, and $1.4 trillion gamble are not contradictory. They are a tightly linked causal cycle. This is no longer just a business transaction. It's a highly leveraged acquisition of the global future computing power supply chain. The true endgame of this gamble might not even be AGI, but a political manipulation, creating too big to fail. By tying the fates of Oracle, NVIDIA, SoftBank, and Microsoft, among others, to itself, OpenAI has created a systemic risk. Its $1.4 trillion commitment is essentially a negotiating tactic, telling everyone, especially the US government, that this endeavor has grown so large that it concerns America's AI leadership and national security. If it fails, the entire tech industry could face a Lehman Brothers moment. Therefore, OpenAI's ultimate backer will not be private capital, but American taxpayers, through CHIPS Act subsidies or federal loan guarantees. This is OpenAI's trillion-dollar gamble. It's not betting on technology, but on politics. It wants to ensure that it becomes a de facto, state-backed national champion, thereby immune to the market forces that might otherwise destroy it.